Market structure in systematic trading gives us a way to organize price behavior without reacting to noise. It provides a framework to read price action objectively, to see whether buyers or sellers are currently driving the move before you place a trade. We will approach this in a systematic, rule-based way. My name is Ashim Nandi. I'm a system architect with 10 years of experience. 6 years in full-time trading and 4 years running an IT company. I built decision systems designed to bring clarity to uncertain conditions without relying on luck. Here are the chapters that will help you understand this clearly. First, the mathematics of structure. How swing points and trends are defined through consistent rules, not fear or greed-based opinions. Second, systematic detection. Methods for identifying structure in a repeatable, testable way across time frames. Third, why structure forms, the behavioral and order flow dynamics that explain why structure persists and why it eventually fails. Finally, from structure to action, a simple framework for using all of this in real time so you know how to evaluate participation as conditions change. By working through these concepts, you will be able to recognize the current condition of a market directly from the chart. And beyond that, you will start relating to price with less urgency and more context, where patience is no longer passive but an active, informed decision. Think in odds, act with discipline. Let's begin. Chapter 1. The Mathematics of Structure. Market structure is built from a simple abstraction, the swing point. Swing highs and swing lows act as reference markers. They describe where price has changed direction in a meaningful way. There is no single universal definition of a swing point. What exists are operational rules. One commonly used approach, often associated with fractal-based methods, identifies swing highs and lows by comparing price to surrounding bars. These methods require confirmation. They introduce lag, and they always depend on parameters. That trade-off is unavoidable. Reducing noise increases delay. Reducing delay increases noise. Once swing points are identified by any consistent method, trend structure becomes observable. An uptrend is defined by higher swing highs and higher swing lows. A downtrend by lower highs and lower lows. The idea is not new. Charles Dow articulated these principles more than a century ago. What matters is not the level used, but the consistency of the framework applied. Some traders describe continuation breaks as breaks of structure and counter-trend breaks as change of character. These are descriptive tools, not market laws. Their value comes from consistent application and context. Understanding definition is necessary, but definitions alone do not tell us how to detect structure systematically. That is where detection methods come in. Chapter 2. Systematic Detection. There are multiple valid ways to detect swing points algorithmically. Each involves trade-offs. One approach is time-based detection, identifying swing points using a fixed number of bars to the left and right. This introduces confirmation delay, but reduces false signals. Other approach is percentage-based detection, requiring price to move a defined distance before a swing is confirmed. This filters noise effectively, but becomes sensitive to volatility conditions. A third approach uses volatility-adjusted thresholds such as multiples of average true range. This adapts detection to changing market conditions at the cost of additional parameter sensitivity. No method is superior in all environments. What matters is internal consistency. Structure analysis improves when aligned across time frames. Higher time frame context helps filter lower time frame signals, reducing false participation. This does not guarantee success. It improves alignment. Detection tells us where structure is. It does not explain why it forms. That requires understanding behavior. Chapter 3. Why structure forms. Market structure reflects collective behavior. Swing points emerge where buying and selling pressure temporarily reach balance. Several well-studied psychological mechanisms contribute to this. Anchoring bias causes traders to reference prior highs and lows. These levels influence future decisions. Visible levels attract shared attention, even without coordination. Reflexivity describes how beliefs influence behavior, and behavior reshapes market conditions. Sometimes structure holds because traders respond to it. Other times participation fades and it breaks. This understanding informs execution. Entries are evaluated relative to structure, stops are placed where structure is invalidated. Position sizing adjusts automatically as structural risk changes. Wider invalidation levels require smaller positions. Narrower levels allow larger ones. Volatility influences how structure behaves. Higher volatility increases breach frequency. Lower volatility increases stability. Structure describes state. Volatility describes movement. Together, they define regime. Chapter 4: From Structure to Action. Now let's bring everything together into a simple action framework. When you open a chart, the first question is not what trade to take. It is what condition the market is in. First, identify structure on the higher time frame. Are swing highs and lows expanding, compressing, or breaking? Second, observe how price behaves around those structural levels. Is price respecting structure or failing to hold it? Is volatility expanding or remaining contained? This tells you how to evaluate participation as conditions change, whether engagement aligns with structure or whether patience is a higher probability decision. Execution decisions make sense only in the context of market state. Entry stops and position size are evaluated relative to structure, not in isolation from it. This is the shift from reacting to price to responding to context. Let's briefly recap what this foundation has built. Risk defines survival. Position sizing defines growth. Expected value defines edge. Volatility defines adaptation. Liquidity defines execution. Market structure defines current state. Now that you can read structure, the next question becomes, how do you adapt when conditions fundamentally change? A structure that works in a trending market fails in a ranging market. A strategy optimized for one regime gets destroyed in another. That is what market regime will give us. The broader context that determines which strategies to deploy and when. This is what we are going to cover in our next video. If you found this valuable, share it with someone who may need it too. We are building a community of traders who choose probability over ego and discipline over impulse. Think in odds. Act with discipline. See you in the next one.